let's explain and interpret car loans. Let's start with the basics, y'all. Cars are expensive, and therefore we generally need some financial help, meaning we get a car loan. So a car loan is just an agreement between the purchaser and the financing party. Now, the financing party could be the dealership, or it could be a bank or anyone else that will loan you money. So the purchaser generally provides a down payment, which reduces the total amount to be financed. Not everybody requires a down payment, so you don't have to have a down payment. But if you have a little cash to put down first, it will reduce the amount to be financed, which reduces the amount of interest you pay, which is great. Let's talk just a little bit about terminology. So, the car dealership or manufacturer is called the seller. The party providing the financing is the lender. So again, the party providing the financing, it could also be the car dealership. So the car dealership could be the seller and the lender. But oftentimes people also go to a bank, a credit union, somewhere else to get different interest rates, that kind of thing. So it could be a third party that is doing the financing, which would be the lender. The party borrowing the money or the purchaser of the car is called the borrower. So just keep those in mind of the three potential people, right? Could be two, could be three people involved in the purchasing of a car. Now, the determination of a car loan. So what goes into determining the interest rate and all of that? Well, when you say, I want to buy a car, this is what I want, the dealership says, okay, let's look at your credit score. Let's look at your credit history. Do you have the ability to make on-time payments? And what is your income to expense ratio, right? So they look at your current debt. They look at all of these things to say, can you really afford a $350 car payment? Because if all of your credit pieces say no, then they either say no, or they give you a longer term loan with a higher interest rate to make it more affordable for you while making them maximize the profits. So you have to make sure you understand all of these different things. The better your credit score, the better your credit history, the less you miss payments over time, right? If you make your payments for all your bills on time, over time, that helps getting you a lower interest rate and better terms on a potential car payment. Okay, now the terms of financing. When we're talking about financing, what does it all mean? So how will the borrower make payments? Are you going to do automatic payments just out of your account? Or do you need a coupon book, right? Which is basically like it kind of looks like a coupon book where it tells you, due on April 1st, you owe $350. If you're late, you owe this much. And you tear it out, write a check. Do people do that anymore? I don't know. Or are you going to just pay online? How are you going to make the payments? What is the payment frequency? Now, most common is monthly, but it is possible to set up bi-weekly payments or something else, some regular frequency. Again, most common is monthly. What is the term of the loan? Meaning how many years? And what is the interest rate? So those two things kind of go in to figure out the term of the loan and also what is the payoff date. Now, one thing I always like to ask is there a penalty for paying off early? Generally for cars, there is not, because interest, the last bullet, is generally simple interest for cars, meaning after you pay your down payment and they know your financing amount, they calculate simple interest and throw it on top. So whether you pay it off in a week or the full 5 years of your loan, you pay the same amount of interest. So generally car loans, they don't care if you pay it off early because you're paying the same amount of interest either way. So those are the four big things. There are others, right? This is not an exhaustive list, but that's a little bit. Now, also, don't forget taxes and fees. So when you go car shopping and it says this car is $30,000, there are taxes and fees on top of that. So it is going to cost you more than just the sticker price. And don't just say, okay, I can afford a $30,000 car, we're great. Cars require upkeep. So oil changes, new windshield wiper blades, fluid flush, new carburetors, all kinds of things. So make sure that not only can you afford the car up front, but that you can afford the cost of the upkeep. Be smart when making that decision. Let's do one quick example. You plan to buy a new vehicle. The sticker price is $26,500 plus $2,405, so $2,405 in taxes and fees. If you want to put 15% of the full price as a down payment, how much is that? And how much will you need to finance? Well, first, we need to figure out what is the full price. So I'm going to add the sticker price and the taxes and fees together. So $26,500 plus $2,405 gives me a total cost of $28,905. Now from that total cost, I'm going to put 15% down. Well, 15% of the total cost, of means to multiply. So I'm going to multiply 15% as a decimal, 0.15, times the full cost of $28,905, and I get a down payment of $4,335.75. So now that I know my down payment, I can figure out how much do I need to finance. I know my total cost, and I'm going to subtract the down payment. So $28,905 minus $4,335.75 gives me a total of $24,569.25. And that is how much I would finance. Now, of course, you can do a lot of other calculations when you're buying a car to decide how do you want this all to go. But if you're looking for a percentage of it for a down payment, this, my friends, will get you there. Thanks and happy car shopping.